we want to sneak it in, sort of have the class wars and say, oh, look, this is only affecting the rich. And then eventually it's, as you said, Sean, it's all, they roll it out into the various other assets. And effectively it's a tax on wealth.
I just find the whole situation diabolical. It is very unnerving, and there is no unrealised capital loss to offset that. I then run the very real risk of losing my entire superannuation balance. There's a chance I lose the directorship. I'm left with a liability to pay back my superannuation fund to pay the rest of the tax bill. You're now losing your personal savings to make good on the superannuation fund just to meet the liability that was incurred there through no fault of your own.
Geoff Wilson said he's going to put all his money in Bitcoin.
Today's episode is one that every Australian investor, retiree and taxpayer needs to hear. We're joined by two powerhouses, legendary fund manager and outspoken advocate for everyday investors, Geoff Wilson, founder and chairman of Wilson Asset Management, and Peter Dunworth, founder of the Bitcoin Advisor. Geoff has been sounding the alarm on one of the most controversial financial proposals in decades, the federal government's push to tax unrealised capital gains and superannuation accounts over $3 million. This is known as Division 296. I want to dive into what does this mean for retirement, the everyday Aussie? Could this be the first step towards a broader wealth tax in Australia? And why some people are calling it the most dangerous tax precedent in the country's history. Geoff, I want to dive straight into this Division 296, unrealised capital gains. I'd like you to explain it. You're probably the most outspoken person in Australia at the moment, but 15% tax on unrealised earnings over 3 million. People are like, I don't have $3 million in my super, nor will I. It's not going to apply to me. I believe this tax is going to affect middle-income people the most. It's not a wealth tax just for the rich. But what are your thoughts, and what is this proposed tax change?
Yeah, look, thanks, Sean, and good to see Peter as well. To me, the sad part is through this election campaign and even now by Anthony Albanese and Jim Chalmers and the various other politicians, they've effectively been gaslighting us all. They're talking about this tax coming in, which is like when you explain what a tax on unrealised gains is, it's sort of like me buying my house. Say I bought it really cheaply. It goes up in value. So and then I don't sell it, but then I've got to pay tax on it. And then the next year it goes up in value a bit more and I don't sell it, but then I've got to pay tax again. And then what happens is there's a housing crash and it falls and I have to sell it because I lose my job, so I sell it. Unfortunately, I don't get those tax credits. The tax I paid, I don't get it back. Eventually, if I make money again, I'll get it back, but maybe my house is sold and I'm not in that position. So to me, people have called it stupidity of the highest order. Some people, I explain it to them and they say, geez, is that theft or is that criminal? Someone the other day, I was explaining to a 32, 33-year-old, and to me the problem is most people in Australia find superannuation a bit complex, so they don't pay attention to it. And when I explained it to the 33-year-old, she said, well, geez, that's madness, isn't it? What they're doing. And it actually is. It's illogical, it's flawed, it's bad policy. Hey, but back on, Sean, what was your actually question? I was sort of setting it up. What was the initial part you wanted me to talk about?
Well, what exactly is Division 296? But Geoff, I think
it's that tax on it's the tax on the unrealised gain. And you said, like, the reason why everyone who's listening to this has got to keep listening to it and pay attention, because if what happens is over time with inflation and investment returns, whatever you've got in your super fund grows. And say if you had $30,000 in your super fund now, then in your 25-year-old, then in 30 years' time, if you didn't put another cent in there, and it grew at 8% per annum, that would be over $3 million. So broadly, with the $3 million cap, at the moment it only impacts 80,000 people. Eventually, it's every Australian that works is going to pay tax on it. On our numbers, we think within the next 30 years, 8.1 million Australians will be above that amount. So to me, that's more than half the current workforce, and that's in the next 30 years. So in terms of back on, I was mentioning how, I believe that the various politicians were gaslighting us. They're saying, look, it's only going to impact 80,000 people, but I'm just sort of taking you through the numbers where eventually it's going to impact everyone. But also what it's going to do is, in superannuation in Australia, there's $4.2 trillion. And what is happening already, people are changing their behaviours in terms of taking money out of super, putting it into principal place of residence, so it's tax-free, putting it into super bonds, which if you own them for 10 years, they're tax-free. People are moving offshore. Like, people are working ways around this system, and the government isn't going to earn, or isn't going to raise anywhere near the amount of money they're anticipating.
Yep. Peter might have a couple of follow-up questions, but just quickly, Geoff, to me, and maybe this is a little bit basic, but because this tax is not indexed to inflation and they've added 57% to them through money supply just in the last 5 years in this country, $3 million isn't very much. But to me, and because it's unrealised, it looks like they could apply this to the family home down the track. It looks like they've come in and they're making a show of, we're going to tax the rich. It only applies to such a small minority of people, and the rich, they're all greedy. They get the Australian population on side. But could this become tyrannical, and could it apply to the family home? Could it apply to small businesses or any other asset that has an unrealised gain outside of the superannuation system?
I mean, that's a fascinating theory, Sean, and I actually think there's a reasonable amount of logic behind it. And the reason I say that is I sort of don't necessarily like conspiracy theories. The bizarre thing is, before this last election, that the government twice tried to get the legislation through Parliament. And the second time they were so desperate to try to get it through, what they did is they attached this legislation, the 296 legislation, the taxing of the unrealised gains. They attached it to another bit of legislation, which was, that pesky, annoying, 1 or 2% you pay on your credit cards. They attached it to that legislation, and to me, hey, if I was a politician, I'd nearly pass it just to get rid of those damn annoying, charges on your credit card. So that's how desperate they were to try to get it through, and good on. The coalition stood against it as you'd expect, but Lambie and Pocock and the crossbenchers, they stood against it. And the reason why there's been this sort of uproar since the election is no one expected the Senate to change the way it did. And everyone thought, they've tried twice and they've nearly tried to bribe the current politicians in the Senate, the crossbenchers to let it through, and they didn't. So there's no chance they'll get it through. And then obviously, Labor won more seats than we thought. The crossbenchers weren't as powerful, and then the Greens actually have the power. So to me, it looks like the Greens will let it through. I know they want indexing, but who knows what happens with Labor. So to me, it's scary. And the fact is, why did they push so hard? And to me, if they bring this in, and once everyone understands how stupid it is or logical or what bad policy it is, taxing a pretend profit that you might never make, it's nearly unbelievable that could be happening in a modern economy. So the real risk is, there's a significantly bigger strategy, and is that bigger strategy? We want to sneak it in, sort of have the class wars and say, oh, look, this is only affecting the rich, and then eventually it's, as you said, Sean, it's all they roll it out into the various other assets, and effectively it's a tax on wealth. So just disincentivise anyone to stay in Australia, or to make money or create wealth in Australia.
Yeah, thanks for that. The only reason I guess I have that thought in my head is I saw a video of Jim Chalmers being interviewed on one of the mainstream media channels, and they're asking, do they have any plans to tax gains on the family home? And he sort of stumbled a little bit and said, no, we're not looking at anything at the moment like that. And just the way that he answered the question, I didn't believe him. It was scary.
I saw that. Yeah, Koshy was interviewing him, and he didn't answer it. He said, "Oh, look, like it's not on the agenda at the moment," or like, that means it will be on the agenda one day.
It wasn't really that reaffirming, and like no other OECD country taxes unrealised gains like this. Like it had set a worldwide precedent. But Peter, do you have any follow-up questions in regards to this? I know you've been talking to a lot of people, and there's probably a lot of people that are listening to this that are ready just to get up and go.
I wouldn't be surprised if a lot of wealth does leave the country. It will definitely leave the superannuation system. The question comes about for that wealth that's trapped there that is unable to leave because of you've got to be defiant, you've got to be reach preservation age in order to withdraw that capital. There's a number of things that are really disconcerting for me about what's happening here, and this is a total rewrite of the incentive structures that capitalism is built on. And what we're rewriting at this point in time is, you're effectively rewarding failure and you're punishing success. So show me the incentive, I'll show you the outcome is really a driver of all human behaviour. And what we're effectively saying is, don't get too big for your boots, don't get too successful, or we're going to tax you into oblivion. And to me, the bigger problem about this is this sends a message that you are not to get a balance more than $3 million. And if we look at the reason why there is a superannuation system in the country was because in the early 80s, the government, Keating and Hawke government, realised that there was going to be a huge tax obligation or huge funding obligation from the federal government to provide pensions. And they wanted to get this off the books into the basically self-funded. And the problem that they're going to create, the unintended consequences of this type of policy is this is going to completely dismantle and unwind the $4.2 trillion that's sitting in there to pay for everyone's retirement. So for this, I look at this and think, if I'm Paul Keating, I am absolutely like kicking the dog about this one, because this is unwinding, one of the greatest legacies that he's left our country. And to me, one of the points around the unrealised capital gains tax that we're seeing across the board, and I hate to tell you, but all of this is already in here. If you look around the country, in Victoria, they have something called a windfall gain tax. And that is literally an unrealised capital gains tax on the rezoning of a property. And the rate on that is 66%. So it's already here, fellas. And I don't know what to tell you, but this is the tax policies that they want to introduce to basically take your wealth. And this is the problem, that it disincentivizes the most productive. It encourages the smartest, the brightest, the wealthiest to flee the country because they don't want to be under an oppressive tax regime. And they've started, fortunately for us, they've started with a tax regime that you can't, or a tax structure that you can't just move your money out of. But that should be a big heads up warning on what they intend to do moving forward. So to me, I look at this and think, Geoff, what can we do to help inform governments of what a bad policy it is and what are the unintended consequences that they'll have to deal with if this comes in?
Yeah. Okay, where do I start? I'm not sure. Actually, just a couple of observations is I've spoken to people who have spoken to Keating, and you're right. Like he's not happy at all, and I think this in theory is going to go through the Senate latter part of July. I think you'll hear more from him as we get closer to there. So, Peter, your question was really, what can we do? Was it, or
what can we do to, I guess, help persuade our government this is a really bad idea?
Yeah, well, in theory, I mean, in desperation, like we wrote a white paper, before the election, trying to get it a bit more publicity. Unfortunately, the opposition, the current opposition, the Libs didn't heighten, didn't discuss it to the extent that should have been in the previous election. And then, in the last week or so, we've started a petition, which has surprised me in the first 5 days. We ran a petition on franking, back in 1819, and I think it took us 5 months to get to 17,000. We ran it for about a year, and in 5 days, this is how the interesting, the concern, how high the concern is. I think we've had about 11,000 have signed up in the first 5 days. So, it's running at like 200%, or it could be hundreds of percents higher than previously. And back in franking in 1819, it was 1 million people going to get impacted. And here they're talking about 80,000, but I think a lot more people understand, like yourself, that they'll get impacted. In terms of what can we do, we've got to change government, but that's unfortunately we're 3 years off that happening. In terms of what can you do to minimise the impact on you? Is that a question too, Pete? Or
yeah, it is.
Well, effectively, a lot of people don't quite understand the actual ins and outs. For those that have more than $3 million, then it's the value of the assets at June this year. And I don't know if you've noticed, but the ATO came out a few days ago and said, "Hey, we're watching you." Now, I mean, you basically talked about it earlier, Pete. Of course, everyone's going to change their behaviour. Whether you're taking money out of super, or whatever you're doing. Now, in terms of the valuation, so any asset you want, any asset you own currently in your super fund, if it's above 3 million, and I know, Sean, you've got a bit of orange behind you, so I suppose crypto.
Wait. Bitcoin, not crypto. It's never crypto.
Oh, sorry.
It's okay.
Sorry. I'm learning. Sorry, I'm learning. It's sort of like when I did my first tweet a year ago, they're all giving me a hard time, and it takes me. I'm in kindergarten here, so I'm learning. So please be kind to me. As I learn.
If you just reference just Bitcoin and you remove the word crypto, you'll do very well. If you start bringing crypto into the Bitcoin conversation, you'll get attacked. And just really quickly to break it down, Bitcoin is money. It's digital gold. It's scarce. It's decentralized. The crypto, to be very nice, maybe it's an investment, a tech play, but really most of it's just a scam. So we want to keep them very separate. We're talking about digital money here, a store of value, and that's Bitcoin.
Bitcoin. Okay, gotcha. Jeez, now where was I going? Where was I going before that? Maybe we'll get back on track. I don't know where I was going, but I knocked myself off track seeing the orange behind you.
I think where you got off track and why Bitcoin came up is January 1st. It's the number. Assets have gone up a lot.
No. Well, sorry. The 1st of July or the 30th of June this year.
Yeah,
is the valuation. So you actually want Bitcoin to be as high as possible. You want all the assets, because this is your starting asset value for, and what they look at, it'll be the starting asset value, 30th of June 25, and then 30th of June 26, and you'll pay that tax on the change in the value over that 12-month period. So ideally, you want Bitcoin to be a really high price at the 30th of June this year. And if it is, unfortunately, if it's a higher price 12 months later, then you're going to pay tax on the change in the value over that period of time. So any property, what people are doing is they're getting properties valued. I was speaking to a super fund guy the other day, and he was saying that he spoke to and someone that's in that category, and I think he'd had 5 valuations on his property, and I think he's going to pick the highest one. I don't know. I'm not sure how that works, but in theory, there's going to be an enormous administrative burden here. How will anyone prove what the value of the assets are in terms of property, and why did you pick that highest one? Did you get other valuations? I don't know how they're going to clamp down on that from a compliance perspective. But in theory, ideally you want your starting value to be as high as possible the 30th of June. Yeah. So let's hope Bitcoin has a big run between now and then.
Geoff, I can tell you from the practical implementation of trying to provide advice around this with the accountants we work with, there are some huge problems. The first being is that this is legislation that hasn't passed yet, so we don't know technically if it's coming in or not, despite all promises that it will. Secondly, it's going to be applied retroactively, or retrospectively. So it's going to start on the 1st of July, which is another major consideration. The third thing is, in creating advice around this for people, we have a big issue because there's a big what if, and this is the problem, that capital likes certainty. And all of these question marks that are being raised around this tax structure are causing people to get very jumpy about adding any additional capital to it. And this is where I can tell you on a personal level, and the clients that we see, the feedback is that they don't want to be applying any more capital than they have to a system that is not rigid, structured, and solid as a rock. They would much prefer to face the consequences of higher taxes in a system that's not changing outside, whether it's in a trust, company, or a personal, as opposed to a system like the superannuation system at the moment that is having all of these crazy ideas tested out in a format that's got $4.2 trillion trapped in it.
Very good point, Peter. Very good point.
I think, Geoff, Peter brought this up a little bit before, and I've linked your description in the show notes below. So please, people, just fill it out. If you're living, you're breathing, this tax will apply to you. That's my takeaway. But aside from the petition and changing the government in 3 years, and I've got another question in regards to that, is there any way that this can be stopped from going through? I know the Greens are in favour of it, but they would like it indexed, which makes more sense. But this is a nonsensical conversation. We're talking about unrealised capital gains. That's nonsensical in itself, but to not index to inflation, I think that's absolute madness. Is there any chance of stopping this, and how before it happens?
To me, it's really the Greens. The Greens hold the key, and if you look at it, as Peter talked about, that 4.2 trillion that's invested in the Australian economy, that's in superannuation. Of that, about a little over 1 trillion or 1.1 trillion is in self-managed super funds. And to me, I think it's a fair argument to try to persuade the Greens that 1.1 trillion, which currently is providing risk capital to a lot of, I'm sure a lot of smaller companies in Australia, I'm sure a lot of renewable green businesses would be supported by risk capital from people's self-managed super funds. Now, if anyone listening to this comes into that category, could you please communicate with one of us about it? Because I've had a couple of conversations with the Greens, and I believe if we can persuade them how the negative impact of that $1 trillion that supports small Australian companies by this tax, which is going to remove the risk taking from that pool of capital, then it's going to be significantly detrimental for small companies in Australia, small growth companies, which the Greens actually don't want that. They don't want, they don't want all the money to end up in the large industry funds or the large union funds. And all those large industry and union funds, they just buy the big companies. They buy Combank. They've pushed it to record valuations. Most expensive global bank in the world now on valuation basis. That's all the dumb money in the top 100 or 200 stocks. The industry and the union funds. So to me, there's an argument that says the Greens actually should be against this. Please, I'm trying to get granular information that we can successfully put that argument to them and get them to realise that how negative it will be for investing in smaller growth companies in Australia.
Yeah, I'll for everyone watching, I'll link Geoff's X account below to be able to get in contact if you have a story that he can take to the Greens. Would be greatly appreciated. Another question, like, why is even an unrealised capital gains tax? Like, why aren't they just talking about realised taxes? Most people, yes, we think the tax is too high and we'd love all to be paying less tax, but sure, tax, live in this country, love the country, happy to pay tax. I'd like to pay less tax, but I'm happy to pay a realised tax. Why are they coming in with an unrealised capital gains? I cannot make any sense of it. I don't know if I'm being naive or...
There's two theories on that. One theory is the theory you were talking about earlier, is that, hey, it's part of, let's slip it in here where it only impacts on the very rich, and then we'll roll it out elsewhere. It'll be a tax on wealth in Australia, which is incredibly dangerous. The other theory is, and the interesting thing is, the day they announced it back in 2023, they announced the tax. They actually didn't say it was an unrealised capital gains tax. So everyone initially thought, it's a tax above 3 million. It was only on realised profits. The next day they came out and said it was on unrealised. And a few people have written about this, and they say that the big industry funds rang Treasury and said, look, we can't work out on a per member basis what the realised tax of each of our members is. We can work out what the total money that they have in there, and we can work out exactly how that money that they have in there changes over from one period to the next. So the only way we can work it out is if it's on realised gains and also unrealised gains. And so they put it in. But to me, it's, why don't they, if it's the people that have got too much money in their super funds, why don't they have a more progressive tax where above 3 million, it's 15% on income, then another 15% on unrealised. Why don't they make it 20% on realised, or 23% above a certain level? Don't penalise the people who've got less money in there. Have a lower level. Have a progressive tax, and then the ones that have 10 million in there, they're paying 40% tax. So to me, have it a progressive tax. To me, that would make a lot more sense.
It would
Geoff,
make a lot more sense. Sorry, Peter, just no, jump in and then I'll come back.
I was going to say, my reading of Section 296, and this will cause, I think, a real stir amongst those who know this, but my understanding of that legislation and changes that were introduced to the superannuation system with respect to accounting for pooled and segregated assets a few years ago, from my understanding and interpretation of the Section 296, this means that every industry fund with a balance of more than $3 million is up for this tax as well, and retail funds. So this isn't just the rich people of 80,000 people who are going to be affected by it. This is going to be about 5 to 10 million people who will be affected by it. And I think this is a law of unintended consequences, that no one's really understood this legislation as it stands. But by my interpretation of it, we stand to have about 5 million people or more taxed by this immediately. So I think this is well worth pursuing, because once they understand, hang on a second, if we apply this interpretation of the law, then we're going to catch 5 to 10 million people in this unrealised capital gains trap. It's going to be a much bigger issue than the 80,000 people who are worried about it now.
Really quickly, ladies and gentlemen, I've teamed up with the Bitcoin Way. This is the professional Bitcoin IT team. They can help you master your Bitcoin self-custody. Safetina Moose, the author of the Bitcoin Standard, also recommends this professional Bitcoin IT cybersecurity team. Their guys are absolutely amazing. They can help you set up a node, protect your stack, get your Bitcoin off the exchange. Make sure that you are following best practices. Number one, that it's air gapped. If you don't know what that means, I've put their details below for you. If you're worried about SIM swaps, reach out to the Bitcoin Way. Maybe you just want to know that you are doing the best thing. You're doing all the little tricks within your device to be able to make sure nobody can ever get into your Bitcoin, have any access. If you've got any queries about connecting to public USB and charging points, connecting to rogue Wi-Fi access points or malware-infected USB cables and flash drives, reach out to the Bitcoin cybersecurity team, the Bitcoin Way. Free 30-minute call. They are at the top of the description.
Fascinating. I better offline. We better have a chat, Pete.
I think so, and that's that's a little bit scary. Jim Chalmers, do not get any ideas. That's
we'll get plenty, and then upset the whole country.
Yeah.
Oh, dude, that's yeah.
Well, it's
go over the top.
They're not talking that way. Like, to me, the unintended consequences.
Geoff, they weren't talking that way before the election either.
No, good point.
I don't know how much we can trust our government when it comes to, trust us, we're not going to tax those people when they get an opportunity to and they're broke.
Don't start me there. Like, in theory, before the last, one and a bit elections ago, we're not going to touch franking. They changed franking. Before the last election, we're not going to touch superannuation. Like, what have we spent the last what have I spent the last month and a half tweeting?
Yeah.
I think it's 100% of my feed nearly, just other stories. And to me, the scary part, we've become close to the laughing stock of the world. Yeah. I'm sure you guys saw the podcast of those 4 young guys in America, just sort of saying Australia's lost it.
All in podcast, presumably.
Oh yeah, it would have been. So my question, sort of like following on from this, is like, everyone knows how ridiculous this is. I'm like even myself, or like people that aren't within the financial system day in, day out. Obviously, I pay attention because Bitcoin means a lot to me and this will affect me. But number one, like, why is it not indexed to inflation? What are they trying to do there? And then, do you believe that Labor believes this is a good thing, like themselves, and they think it's going to do good in this country? Like, do they believe their own bullshit? And are they like totally unaware of how dystopian this possibly can be? Or they actually know, and like you're saying, it's just gaslighting to be able to push it through to drive a deeper agenda for whatever that could be?
Yeah, I think they do know. And there's been articles in various papers saying that a number of Labor politicians are against it. Obviously, they've got to toe the line publicly. So it's all backroom whispers. And like Keating's, sort of come out. Kelty, one of the great union leaders, he's come out against it. Like, anyone who understands it's against it. The only way you can say, it's fair. Well, you can't. But the only way you can try to justify it is saying, well, okay, they've got more than this in there, so they should pay more tax. It's not a fortunate tax, but they should pay more tax. What they just don't realise is, as Peter said before, is the unintended consequences are going to be significant, and the government's is not going to raise anywhere near the amount of money they think they'll raise. People are going to change their behaviour. Peter was talking about that. we've done some analysis, and we think like 150 odd billion could come out of retirees that have their money in super funds, and that could go into the housing market by people that have got more than 3 million in their super funds, bringing it out and if they're older, and giving it to their children and grandchildren to buy their principal place of residence or pay off their mortgage. And in terms of the negative economic impact, we've come up with a figure. It'll be negative of 94.5 billion to the economy in terms of the loss of employment, because all those startups or all those high risk venture companies or angel investments, they don't occur. And to me, people move from having their money in sort of growth companies to have it. You're better off in your super fund. You're better off just getting a yield. Why take the risk on capital? Like talking about Bitcoin. Say if I had all my money in Bitcoin, and
Good
over
idea.
the last, that'll be a quote. Jeff Wilson said he's going to put all his money in Bitcoin. Well,
good idea, Geoff.
Great idea.
Yeah. So, but to me, you look at it and you look at the drawdowns in Bitcoin. So they're 80% drawdowns. So you've got to be in for the duration. And if you happen to have to pay tax on an unrealized gain before that drawdown, then you're gone. Like, to me, you can't. You'll be selling at the worst time, and you'll
Geoff,
have no.
I'd like to
Sorry, you go, Pete.
I'd like to expand on that thought if possible. Like, there's a very real possibility that those who are fully invested in Bitcoin with those 80% drawdowns are left with a tax liability that is higher than the fund balance. And this is the unintended consequence I'm talking of now. If you run a self-managed super fund and that happens to you, there's a few major problems. Let me just go through them very quickly. But if you have that 80% drawdown and you've got a tax liability, there's a very real chance that you have a tax liability that ends up being more than the entire superannuation balance when it comes time to pay that. So the downstream consequences of that are, firstly, you're trading insolvent. So you now lose the right to be a director of a trustee of a self-managed super fund, run a self-managed super fund. You can't be a trustee of a company. You can't be a director of a company. You can't hold an Australian financial services license. You can't be a financial advisor. The list is endless. That's the first thing. The second thing is, as a trustee of a self-managed super fund that has a liability, the ATO can then come after you to make good on that tax liability that you haven't paid. So now you're losing not only your entire pension balance, you're now losing your personal savings to make good on the superannuation fund just to meet the liability that was incurred there through no fault of your own. And there's no mismanagement. For anyone who's been in Bitcoin for a few cycles, they know that these 80% drawdowns come and go. But the beauty or the way to solve that problem of that 80% drawdown is just to hold through the volatility, and duration becomes your friend. But if you are having to pay a tax at the top and then deal with a drawdown, and then you've got the liability to pay when it's drawn down, all of a sudden you'll lose your entire superannuation balance. You'll have a personal liability, and then you have the very real prospect of losing your ability to become a director of a company or give investment advice, as I do now. So I look at this and think, I know for me personally, this represents an existential threat, because if I look around the investment universe at this point in time, I think property is severely overvalued. I think we're overvalued from a PE perspective in the stock market. Bonds and cash are uninvestable because we're getting debased by the tune of 10% per annum plus whatever the CPI figure is. To me, there's only one safe haven to find, and that is Bitcoin. But I'm going to be penalised personally for this, and all of those laws of unintended consequence are going to fall squarely on my head when I don't see a viable investment option for to secure my future. And the very real problem that a few of us face is that it's 17 years before I can access that money and take that money out of my superannuation fund. So I am trapped there. And just doing some analysis on this, I've figured out that based on the tax law that we've got, if I'm the greatest trader in the world that's ever lived, and I have God knowledge on when the top of the Bitcoin cycle is going to be, At the very best, I can hope to keep 8% of my current Bitcoin. At the very best, I can hope to keep 8%. So I will be taxed 92% in my superannuation between now and the age of 65.
Far. So is that assuming? That's assuming.
That's the best case. That's the best case I can hope for. If I manage to sell every top between now and 65, 17 years down the track, I get to keep 8% of what I currently have.
Oh, and that's assuming the volatility is similar, or the drawdowns are similar to what we've had historically, does it? Or is that?
That's assuming I can sell every top, which you and I both know is impossible.
We know, that's right. Yeah, the only people.
So the reality of what I face is I will lose my entire superannuation balance, or I'll have to go to cash, where I'll get debased and robbed by the money printer printing 10% more per annum. So it's a very dire consequence, this legislation. So the reality is I need to move my balance to cash, or alternatively stick in Bitcoin and run the gauntlet and think I can outperform God when it comes to trading Bitcoin, which I know is an impossibility. And because of this, there's unrealized capital gains tax, and the problem is there is no unrealized capital loss to offset that. I then run the very real risk of losing my entire superannuation balance. There's a chance I lose the directorship. I'm left with a liability to pay back my superannuation fund to pay the rest of the tax bill. I'm probably fined by the ATO or ASIC for trading insolvent, lose my financial services license, lose my ability to give financial advice, provide food for my family. It's kind of a dire spot that I don't think a lot of people have really thought about, but they'll look at that situation that I'm in and just say, oh, we'll just go to cash. It's like, well, I don't want to go to cash because you're robbing me to the tune of 10% per annum.
I know. Hey, Pete, don't worry. Equities. We've got a few equities over here. I can talk about a few listed investment companies you can invest in that we manage.
Without 80% drawdowns?
No, not 80% drawdowns.
Yeah.
See, the good thing is the drawdowns in the equity market tend to be about 50. So you still have a little bit of money left. If you can
enough to pay.
The great thing is we've all learned. I suppose Sean's the youngest, I'd assume. He's got the most hair, but we've all learned that that you got to stick in there for the medium long term, because we can't pick the tops and we can't pick the bottom, and volatility. As you sort of said, Pete, volatility ends up being your friend if you can hang in there for the duration.
Yeah. I was in high school, 2008, 2009 financial crisis with what happened in America. But like with my parents' super and stuff, if people just kept the money in there, they're fine. Same with COVID. If they didn't panic sell and they just wrote it out, they're in a better position today to be able to do it. Same with Bitcoin. You have to be here, and it's like a 5-year minimum cycle. So you ride out those ups and downs. Geoff, I got a couple of questions that I'd like to ask in regards to this, and then just super rapid fire. Unfortunately for everyone that handed them in, I'm not going to get to everyone's, but we'll get through, say, 3 or 4 minutes with the questions, and then I want to talk about Bitcoin and bring you in, because you've just read the big print, which is pretty exciting. But before we get to the bright orange future, Geoff, from Mike, and I don't know if you can answer this in their entirety, but Mike's question: what is the most effective legal strategy you're using or recommending to minimize Division 296 tax? And is it something smaller self-managed super funds like mine can actually apply?
Well, obviously, I know for my position, I've got more than $3 million in super, and I'm not going to change anything. Obviously, I've got a property in there, so I'm going to get it valued. To me, if you're like as Peter said, unfortunately, if you can't take it out, even though like in terms of I could take it out, I'm above the age you can take it out, but it still is, the tax I'm paying is less than I would unless I put it into my own home, which is tax free. So it still is good for you. I don't think there's a real strategy. Yeah, you've got till next year if you're just above 3 million. Yeah, you've got till next year to reduce it. It's 30th of June 2026. Where if it's 2.99 million, then obviously you're not in the the category of the the 296 tax. So that's I haven't got a great. Have you got it, Peter? Have you got any great strategies around?
Sadly, I don't think there is for those who are, I guess, pre-preservation age. It's very difficult to do that. I think having your assets valued as in their best light might be a way to lower the impact dramatically. Yeah. I can tell you, we've spoken to a whole host of clients that that we've helped with in the past who have significant property holdings in their superannuation. And we're having conversations with them pre-30 June to figure out a plan of action to get that. It's looking likely that those properties will be removed from their superannuation fund. And they're big chunks of assets, like tens of millions of dollars, that need to be withdrawn from the super fund because they're going to incur those yearly charges on it. So it then comes down to assessing whether or not it's going to be do you pay the stamp duty in order to get that property out, and then the capital gains tax to do that in order to not be hit by that. The problem here, Geoff, as well, is that trying to plan for any of this is impossible because we don't have any firm guidance on this. Parliament doesn't go back for another couple of months, and we're not going to. Then we're going to get this retrospectively put in. So I just find the whole situation diabolical. It is very unnerving, and this is where there's no gravity in this situation. There's no up and down. Like there's no true north that you can create a bearing from to actually create the advice around this because nothing is in stone yet they tell us it is.
Yeah, and now I think what you said is if your starting point is all valuations are full for your starting point on the first of July 25.
Yeah. That might soften the impact some.
And then what about like the option, I've got a self-managed super fund, it's 100% Bitcoin, and, like very realistically, this is going to apply to me in short order. Is there any point that I keep contributing like over and above the minimum to that?
Hell no.
Or should I keep growing my super fund?
You're not growing your super fund, no way.
I'm just growing
all
it for
of it.
them.
You're just growing a liability in the future.
Yeah,
that's the risk. That's the risk of the timing of. Actually, what I didn't do is I should have looked back. Is there any seasonality? With the other drawdowns in Bitcoin and the sort of the 5 big drawdowns has had of like 80% close to. Does it happen at any particular time of the year or?
Yep, usually 4 years to the day.
Every 4 years and months.
It's like every September, I think, isn't it?
Oh no!
November.
Oh, no!
Every November is the top.
Oh, geez. Okay. Oh, so June.
And then it bottoms out typically a year or two later, like maybe 6 to 18 months later. It sort of is on a downward trajectory.
Okay. So it could be June, goes a bit higher, and then whoosh, and then you got to pay the tax on back there. Okay, let's keep going. Next question, please.
I think I'll just ask one more, and this one's from Cass. If it comes into effect, like, what are the options, I guess? Like restructuring depart in Australia, but it's the last part. What are wealthy Aussies doing now to get ahead of it? Will we see a mass exodus of Australians over the next few years? And can those Australians take their superannuation balance with them?
Okay, well, let's have a look at what happened. And this isn't exactly the same, but in Norway, the only pretty much the other place in the world that they've tried something like this is in Norway, which is but it was a tax on unrealised capital gains, but for the super rich. So it was only a really small percentage of people, and they expected to only raise, I think it was like $146 million. Like it's not. We're expecting, we're taking a bit from everyone and we expect to, get a couple of bill, which they won't get, or the government expect. And what happened is, I think it was all the super rich, they worked it out and they all left. And I think it was 56 billion of assets left. And instead of raising that money, they end up being negative. 500 million, so $500 million. So it was similar, like in the UK, they bought the tax on realised gains over there. They increased that about 20%. So you'd think, oh, geez, you'll raise an extra 20% of the tax. Well, actually, they're down 10%. A little bit like you were talking about Victoria earlier too. And what's happened in Victoria? Oh, we need some more money. Let's increase the tax. On stamp duty on houses. So great. All the house prices have fallen. So they're going to raise less money. Cigarettes. That's another one. Like they don't realise for every action there's a consequence or a reaction. And let's tax cigarettes more. Oh, now we got let's create. They've just created a black market and raised less money. So to me, unfortunately, I actually don't think it's at the stage at this point in time of people leaving. But I know of a couple of, I know an academic who actually I met on X, and he's leaving because he's going to somewhere where there's no capital gains tax. But back on your question, it was, will people leave, and then will there be a bit of a brain drain? I think there will be. The thing is, depending people will take risk. Where will they put their money? They'll try to put their money in their principal house of home of residence, or they'll find there's these like insurance bonds that I think if you own them for 10 years, there's no tax. Actually, we're thinking of creating one because you won't want growth. You want income in your super fund, which sort of is crazy. It's the reverse of what you should be doing in your super fund. You should be taking a medium long-term view and having growth assets. And when you're younger, that you want the highest growth possible. So anyway, does that answer some of the question, Sean? And Pete might have the rest.
No, 100%. I guess quickly, is your hard stop at 4, or can you go 5 minutes over, Geoff?
Yeah. No. That's not a hard stop. I'll just be late for my next one. That's cool.
Cool. And Peter, you're okay?
I tend to run late.
Good for 10.
Cool. Lovely. I've got a lot of questions, but Geoff, I interacted with you. I recommended the big print, and you actually put in the work. You read the book. Like, congratulations, well done. Most people don't
listen to the book. I listened to the book. Yeah,
that's shout out to Walker America, who narrated it. Very incredible human being as well. And how was it? What was your takeaway? What was your experience of your first Bitcoin book?
Oh, well, obviously, being aware of Bitcoin. And, I mean, one of the things I love about Bitcoin, and I can't talk about the other coins, but what I sort of love about this is it's introduced a whole a whole segment of the population, intending to be younger people, to a market and to markets and how markets operate. And to me, and to understand volatility and understand markets. So I was aware, obviously, of crypto and Bitcoin, and reading the book. Did it surprise me? Not really. Like, to me, being in a market and observing what's happening and understand, seeing money pumped into the system and potentially inflation and the impact of that. Now, does it mean I'm going to go and buy Bitcoin? Hey, I'd love a drawdown of 80%.
Both of us here would too.
No, we all would. And when it's happening, we won't buy because we'll never buy at the bottom. And
Speak for yourself, Geoff. I'm a buyer every day.
Good work. So, yeah, did I learn more things? Yes. Did I? Yeah. Is it like everyone looks at things through different lenses, and it was a fascinating lens to look at the world through. Does it mean I will own Bitcoin? Possibly or possibly not. To me, you sort of can't. Well, I know this is probably politically incorrect, but I think we've done a few politically incorrect things already. In terms of comments, like you can't kiss all the pretty girls. Like to me, my expertise is equities. My expertise isn't necessarily Bitcoin. Have I learned a lot more? Yes, I have. Will I? What was it? What's the other book? What's the next book I've got to read? Exactly. That's
Standard.
it. Oh, the Bitcoin Standard. Was it? There was another one too about ripping up
for Bitcoin.
Yeah, that was a Bitcoin. Oh, anyway, to me,
I'd recommend probably that as your next book, Geoff.
Yeah.
What do you reckon, Peter? Or
a gold standard a gold standard, both excellent.
Yeah. Okay. Yeah. To me, it's learning, and the more you know, it's sort of like when you buy shares in a listed company. The more you know about that company, the more comfortable you are with that company, and the more likely you are to hold on to those shares in that company when things get a bit tough. So to me, from an education perspective, like I'm really, hey, with the Bitcoin or with I'm really it's sort of in kindergarten in terms of getting up that information curve and observing it and seeing what happens and collecting information. So at some point in time, I'd want to be in a position when I did buy some, then I would be confident, and I wouldn't be shaken out. When there's a big drawdown. So so to me, it's just the early part of my. You guys are so much further down the track. Like when did you? Here we are, Pete. When did you buy your first Bitcoin?
2016.
Far out.
Let's go.
Gee, good work. And sure, what about you?
2019.
Yeah. Okay. Yeah. So
first heard about it 2013, and I just was not educated enough.
Yeah.
But sorry to cut you off, Geoff, but you made such an important point that I really want to drive home. Where you are now, you probably now understand Bitcoin more than 98% of the population after reading that one book, The Big Print by Lawrence Lepard. And what you said is you feel like you're still in kindergarten and you want to learn more, and there's the Bitcoin standard, the gold standard, etc. But I just want to say, I take my hat off. I really respect that. You know a lot more than you're given credit to, more than every mainstream media channel out there, more than politicians and the rubbish talks and takes that they've said lately. But a lot of people come from a place like they understand Bitcoin or they know about it, and it's not just for them. You know a lot more than most, and you realize that it's still a learning process. And I think that's pretty powerful for the audience. It takes 100 hours of study to get a good understanding. Just listen to 13 and a half and knows that he needs to keep learning
87
more.
to go.
I know. Hey, what about the poly? What was the one about eating Bitcoin?
Yeah, so that is Senator Jared Rennick. You cannot eat a Bitcoin. And the worst thing is I've been trying to talk to Senator Rennick, or have been in private conversations for the last 9 months, trying to organise a roundtable to get him in front of people like Lawrence Lepard, just to be able to give free education. If he buys it or not, doesn't matter, but it's what I think is a better form of store of value compared to saving money in fiat dollars, which is debased in at 11% per year.
Peter, the funny thing is on that, when I saw that, and I was ready for my tweet, and I was going to say you can't eat gold, But then I thought of, how occasionally you go to a really, really expensive restaurant and the dessert will come out. It's some chocolate mousse with a little bit of gold on. And I was thinking,
gold slick vodka.
I know. Well, you can. Well, exactly. You can eat gold. And then I had to Google, I can eat gold. So then I had to change my tweet. So I couldn't come up with a good one though.
Yeah. But like money, housing, real estate, oil,
we can't eat
crude
that.
oil.
We can't eat, don't drink oil. Exactly. That's right.
Futures. It's none of it's good.
Yeah. On that point with Senator Rennick, and I'd love the opportunity to discuss this with him. To me, the key thing about Bitcoin is it divorces Wall Street speculation from Main Street consequences. And so what we've seen in the last 20 years with the GFC and the like, we've seen Wall Street speculation on credit default swaps, mortgages, effectively residential property, have Main Street consequences where people have lost their homes, funding rates went through the roof. This is why we probably have a cost of living crisis, because we have effectively all of these money markets betting on residential and commercial property markets. And the fact that you can't eat a Bitcoin is precisely the reason that you want to have Bitcoin, because it allows Wall Street to speculate on a highly volatile asset without having mainstream consequences that impact the cost of living and housing crisis that we work through.
And the tough thing is, if you could eat Bitcoin, there'd probably be nothing left.
It's gone for good.
That's right. Never coming back.
Actually, Sean, one thing I want to bring up, which I think warrants, given the discussion we've had, which we haven't talked about, which I really want to make a point of bringing up. We haven't talked about the fact that the people who are bringing this legislation into existence are not going to suffer the consequences of it.
Well, yeah, that's that's a very good point. Are we allowed to bring that up in our last sort of 5-10 minutes?
I think there's no other way to say it, and I want you guys to bring a little bit more thought around it. But I think it's absolutely totally fucked up and disgusting, and it's the destruction of this country. They know it's a bad thing because they're exempting themselves for it, so they're going to come in here and they're going to enslave everyone to be a wage slave, a tax cattle for the rest of their life. That's the way that I see it. Maybe you've got a more balanced take on it.
The more balanced, and because Jim Chalmers came out yesterday and is fired right up. He'd obviously been beaten over the head in the last week or so, done a whole lot of research, and I assume he looked as though when he was interviewed he was reading something, so I assumed Treasury had written something for him. And how it works is there's going to be some state politicians and judges that it doesn't apply to at all. In terms of Anthony Albanese, the leader of the country, it doesn't apply the way it applies to everyone else. He's in a different category, and in theory, he doesn't. In a year's time, when we're all filling out our tax return or potentially paying tax on unrealised gains, or in 10 or 20 or 30 years, when various other people are paying, the younger people with inflation are paying tax on those unrealised gains. If Anthony Albanese, well, how his works is his defined benefit. He doesn't pay tax while he's working. And so he gets the benefit of what the eighth wonder of the world,
compounding through time without interference.
Yeah, without interference. He pays tax when he retires, and the tax rate he pays it at. The interest rate he pays it at, and I've tried to look through all the legislation, but it hasn't come out. All the bits. It looks like at about 6%. So he's compounding at a higher rate. Like, to me, if we could all gear up at 6%, then we'd take it. The interesting thing is, in the legislation that Chalmers talked about in 2024, March 24, or the work, Treasury was talking about 8%. And I think the politicians are saying, no, let's drop it to 6%. So what's good for the goose or I think a few people on X have talked about Animal Farm. It's disappointing. It's disappointing.
Yeah, it reminds me of Atlas Shrugged by Ayn Rand.
It's only a rort if you're not in on it. It's a big club, and we ain't in it.
Unfortunately, we're not in it.
I don't know if I'd want to associate with the likes of them anyway. I'd rather be talking to gentlemen like yourself. We have come to the end of the time. I'm going to link all your information below to both Peter and Geoff, but give you a minute each. Guys, if you'd like to finish off, starting with Geoff, if you've got any words of wisdom or anything we didn't cover that you think is important to get across.
Hey, look, thank you very much. And I suppose what I've learned, when I started investing, and this is in the stock market, say back 40 odd years ago, I always thought that it was important, like market timing. I mean, obviously, I want to sell at the top and I want to buy at the bottom. And over time, I've realised that's not possible. I've probably realised that it's time in the market, and that's it doesn't matter which market. It doesn't matter if it's the Bitcoin market or the equity market or whatever the property market, but it's time in the market, and just being able to sort of buy when everyone's fearful and sell when everyone thinks it'll go on forever. So to me, it's really that it's a long game, and position yourself for that long game.
Love that. Completely agree. Peter?
I'd like to take the opportunity to support Geoff's effort to get as many signatures as possible for this petition to say no to the unrealised capital gains tax. If we can do whatever we can to do that, so everyone watching, who's invested an hour to get to this point, Geoff's done one of the most important initiatives in this. So I think I would really like to see everyone support this initiative that Geoff's put together. I think it's a fabulous idea. Let our politicians know that this is a really detrimental thing to a whole host of Australians that I don't think they really understand the problems that it's going to cause. So, Geoff, thanks for the initiative in putting that together. And Sean, thanks, mate, for putting us together to help spread that message and hopefully get another 10 or 11,000 or 20,000 signatures on that petition, because I think that's the most important thing we can do to say and show how important this is, that we don't like it and we understand how bad it's going to be.
Yeah, I just want to both of you gentlemen say thank you so much. Geoff, truly appreciate your time, as well as Peter, and to reflect Peter's thoughts, please sign the petition, read it. The breakdown, that paper, discussion paper you put, Geoff, that's an amazing read. I didn't quite get to the end. I think it was like 28 or 32 pages, but I tried. I did give it a red hot go, but absolutely incredible the work that you're doing and the awareness and pushing it out there. All the information's there. The petition's below. It'll take you 1 minute. If you don't think $3 million will apply to you, it will. And if you still don't think it is, maybe learn to study Bitcoin and then it will. But whatever we can do to stop this, Geoff, stay in contact. And if there's any way that we can continue to support you further, personally, as a Bitcoin community, just shout out.
Thanks, guys. Thank you.
Thank you. Everyone, please do something nice for yourself today, for somebody else out there. Be blessed. Peace.